There's a lot that has been written about the best way to invest. From overarching strategies and long-term goals to the nitty-gritty of actually buying and selling investment assets, there is an almost overwhelming amount of information out there. But while everyone focuses on how to plan for retirement, almost no one focuses on creating a backup plan. What happens if you aren't able to save as much as you hoped? What happens if your investments start underperforming? What happens if stock markets enter a years-long bear market? Those are the types of questions that investors need to ask themselves and prepare for if they want to ensure that they can live comfortably in retirement. Are you prepared for a crash? A recent survey by Country Financial showed that 44% of Americans aren't ready for a stock market crash. If the Dow were to drop by 6,000 points, or about 25% of its current level, they would be caught completely unprepared. That's not an unprecedented drop in terms of percentage, as both the Dow Jones and the S&P 500 lost over 50% of their value during the 2008 financial crisis. But with stock markets having been so high-flying the past 2 years, many people have been lulled into a false sense of safety, thinking that markets will continue to remain hot. If they don't begin to prepare now for an eventual crash, then they will risk losing significant amounts of their savings once the crash finally occurs. Is your portfolio diversified? That's why portfolio diversification is so important to investors. It's great that so many millions of Americans invest in 401k programs, but in many cases their investment options remain very limited. Many 401k programs offered by employers only offer a small selection of investment options, and often are very heavily weighted towards stocks. That's great when stock markets are doing well, but not so great when they start to decline. A 401k is okay to form the beginning core of a retirement investment profile, but a well-developed and well-diversified portfolio will include bonds, real estate, gold, and other investments. At the back of the investor's mind should always be, if the worst-case scenario comes to pass, how will my portfolio perform? How has your portfolio performed? It's important to take a good, detailed look at how your portfolio has already performed. Stock markets have done really well over the past 2 years, but how have the stock investments in your portfolio performed? Are you invested in individual stocks or in funds? Are the funds you invest in actively or passively managed? Have the funds you've invested in outperformed the market, equaled the market, or underperformed the market? The long-term performance of actively managed funds isn't too great. Between 83% and 95% of actively managed equity funds have underperformed the stock market over the past 15 years. That's not a great track record, and means that you could be losing out on significant gains if you stick with subpar investments. Even gains of 1 percentage point less than you could be gaining could result in tens of thousands of dollars of missed gains over a 15-year period, and potentially hundreds of thousands of dollars over the 30 to 40-year period you'll be investing in before retirement. The role that gold can play, because diversification is so important to both the health and performance of an investment portfolio, it's important for investors to diversify properly. Too many investors invest in a mix of stocks, bonds, CDs, and other financial assets and consider themselves well diversified, forgetting that all of their assets will move with the whims of Wall Street. Failing to invest in counter-cyclical assets is the Achilles heel of all too many investors. Thankfully, there are plenty of ways for investors to protect their hard-earned savings from the ravages of stock market crashes. Chief among those is gold, which has been trusted by savers and investors for hundreds of years. Gold isn't a sexy asset that sees the huge spikes that stocks do, but it holds its value year in and year out. In fact, since 1971 gold has even outperformed the Dow Jones and S&P 500. That makes it ideal for investors looking to protect their retirement portfolios against the risk of a stock market crash while not sacrificing possible future gains. With the development of gold IRAs, investors can invest in gold just like they would invest in any other financial asset, even enjoying the same tax advantages and being able to use existing retirement assets to purchase their gold. So if you understand the importance of diversification and want to take the first steps to creating a backup plan to protect your retirement assets, you owe it to yourself to take a look at gold. We're stumbling into another stock market crash. Inflation confuses analysts and raises stock market crash fears. US inflation is confusing analysts. Some data suggests that consumer spending is dropping. In other words, consumers are not confident. They're either delaying or avoiding big-ticket purchases such as cars and large appliances or electronics, as retail sales have dropped for 3 months in a row. The data suggests that the Dow Jones will retract. It's a signal of an impending stock market crash. Those who thought the inflation data might calm investors' fears will be disappointed. The inflation data is lower. Yes, the Federal Reserve could consider delaying its plans to raise interest rates. It may even go as far as limiting itself to 3 hikes instead of the expected 4, as the new Fed Chair Jerome Powell hinted in February. Therein is the problem. Inflation is rising, and rate hikes are seen as a cause-and-effect mechanism that stems from favorable economic factors. But it seems that this mechanism is flawed. As Powell presented it, it has optimistic implications. Yet, as reality shows, the implications are slanted more toward the pessimistic. Analysts and economists will have to catch up to consumers. Sentiment is softening and volatility persists. How long can it be before there's a major stock market crash? If the markets feared the Fed's rate hikes in February, analysts explained that they feared the higher borrowing costs and, therefore, the higher costs of investing on margin. The Federal Reserve's inflation predictions are unrealistic. The lower inflation now shows that the Fed, and many others, was too optimistic. At the next Fed meeting, on March 20th, Powell is expected to raise rates to 1.75%. The lower consumer confidence and the overemphasis on inflation suggest that there is a distortion that will not benefit equities. Powell now faces a Shakespearean dilemma: to raise or not to raise? The US dollar will suffer. Indeed, the euro/USD exchange is at levels not seen since 2014, when nobody was discussing raising interest rates. There is a situation of confusion. It was inevitable, given President Trump's executive style, that the markets would eventually catch up. It seems the wild bull that started after he won in November 2016 has seen its best days. Panic selling. The risk of panic selling remains. Economic statistics are almost as unclear as the president's intentions, no doubt a strategy that has worked for him in business. That's why the risk of panic selling is high and why a stock market crash is always within reach. In early February, the flash crash that resized investors' ambitions was explained as a response to inflation. The media was bustling with reports of how great the latest job numbers were and how these would drive inflation higher. But few bothered to consider the kinds of jobs that accounted for these great numbers. The growth came from low-paying jobs, not the kind of growth that is going to drive up inflation. Yet, Powell will likely go ahead with raising rates at the end of March. He could deal a major blow to the retail sector, which is also bracing for the effects of the trade war with China that Trump has started. The markets will not absorb the $60 billion in tariffs against China without delivering a bearish message. However much the stock market benefited from Trump's tax cuts in December, they could suffer from an extended depression in the next few months. Nobody knows why markets are down yet. While analysts and investors try to make sense of the markets, nobody has yet identified the real cause of falling stocks on Wall Street. There is simply too much disorientation. That's why stocks have not stabilized. Perhaps because it's difficult to gauge market sentiment, investors have not yet taken a clear course. That's why stocks, with a few special exceptions, are fluctuating between bearish and bullish. Wall Street drives the world market, and the pattern of confusion is contagious, spreading to the European and Asian markets as well. The big risk now is that investors are wondering, if not outright panicking, if they should sell. The impression they have is that the market's gains in 2017 have all been one giant bubble that investors have inflated since the day Trump was elected. But, rather than assuaging fears, Trump is doubling down. The stock market is worried about what is happening in the White House. Trump has lost 2 big chess pieces, Chief Economic Advisor Gary Cohn and Secretary of State Rex Tillerson, within the span of a week. Both probably objected to Trump's tariff strategy and other sensitive issues, such as relations with North Korea, Russia, and China, of course. In such an environment, investors are nervous. They are, therefore, unable to predict the course of the economy from one day or 1 hour to the next. The inflation and interest rate concerns merely add to the dilemma. Disappointing retail sales suggest that the Fed may not apply 4 rate hikes this year. Rather than take this as a bullish signal, investors will eventually reach the only possible interpretation: the U.S. economy is not performing as well as we think, and stock prices are too high. Investor sentiment turning? Bigger stock market crash possible in 2018. Earnings surprises are foretelling a stock market crash. If you own stocks, you might want to read this. The stock market could disappoint in 2018. Don't get too complacent just yet. There are developments suggesting that a stock market crash is still a possibility this year. Go back to late 2016 and 2017. No matter what companies did, their stock prices increased. Earnings didn't really matter to investors. This was mainly because investors were optimistic about the US economy and believed that everything would be just fine. We are now seeing investor sentiment change. Remember, sentiment is one of the key things that drive the stock market higher or lower. If investors are optimistic, they buy and the stock market soars. If they are pessimistic, we face a stock market crash. How do we see investor sentiment changing? Usually, Wall Street analysts provide earnings estimates. If companies beat those estimates, their stock prices rise. The difference between what the analysts were expecting and what the company actually reports is called a surprise. A positive surprise is when a company reports earnings higher than analysts were expecting, and a negative surprise is when a company reports lower than what was expected. In normal markets, the bigger the surprise, the bigger that the swing in the stock price could be. Companies posting positive surprises are getting punished by investors. It tells us that investors are anything but optimistic and that the stock market could face a lot of headwinds. Fourth quarter earnings, investors selling companies with solid earnings to get some perspective. Consider this: during the fourth quarter 2017 earnings season, S&P 500 companies that reported positive earnings surprises actually witnessed a decline of 0.2% on average in the 4-day period, 2 days before and 2 days after earnings date. Over the last 5 years, S&P 500 companies that reported positive earnings surprises increased by 1.2% on average in the 4-day period. Digging a little deeper. For the fourth quarter, 366 companies of the S&P 500 reported positive earnings surprise. Of those 366 companies, 57% of them, 207, recorded a decline. Those 207 companies reported an average decline of 4% in the 4-day period. Of those 207 companies, 13 saw double-digit declines. Stock market outlook for 2018, don't rule out a massive sell-off, dear reader. In early February, we saw a mini stock market crash. Key stock indices like the Dow Jones Industrial Average and the S&P 500 declined 10% in a matter of few days. That may just be an episode of what's ahead, a bigger stock market crash. The phenomenon of investors not rewarding companies by buying their stocks, even when the companies are reporting stellar financial performance, is worth watching closely. I believe that when investor sentiment is turning, it may be a good idea to focus on capital preservation. What is capital preservation? It could be as simple as setting stop losses on positions in a portfolio. Remember, the declines are usually much faster than the rises in the stock market. So, stop losses could protect investors' portfolios from deep losses. The erosion of the middle class marks the end of the American dream. Does the middle class still exist? Many Americans who describe themselves as being Democrats or on the left continue to chase Russian ghosts. It must hurt less to project the cause of trouble on an external enemy than it does to look for the real cause of the problem at home. They are especially pleased about the opportunity to continue delaying coming face to face with the real issue that few would dare explore: the demise of the middle class. Hillary Clinton can rejoice in the fact that Vladimir Putin won a fourth presidential term in the Russian election. It was a triumph. She and her supporters can continue to direct the blame for her loss eastward. It means she and the Democrats can avoid self-examination. Indeed, few are shocked. Prestigious scholars discuss the socio-economic shift in American society and beyond long before Donald Trump decided to run for president. But perhaps, unlike Clinton's associates, Trump's advisors read a few articles and took notice. If you woke up with an academic appetite, you could try reading the article Testing Theories of American Politics, Elites, Interest Groups, and Average Citizens by Martin Gillens of Princeton University and Benjamin Page from Northwestern University. Surely, some of Trump's mentors and those advising Bernie Sanders read it. Yet, I wonder if Clinton and the gurus from the Democratic Party did. The smart money is on no. Aristotle's Message for America. Even if the report has some academic flaws, as some have suggested, it reflects a concern that many Americans are increasingly sharing. Has the United States become an oligarchy? In simpler terms, does the middle class even matter in America any longer? Are you part of the middle class? 10 years ago, this question was one of the major interests of sociologists and snobbish people. Now, it is a very delicate political issue. To understand why the demise of the middle class matters as a threat to the economy and to democracy itself, the classical Greek understanding of middle class is useful. Indeed, no less a figure than Aristotle discussed the concept of a middle class, even as it has changed over the past few centuries. The famous Greek philosopher and tutor to Alexander the Great, who would conquer much of the known world of his day, described the middle class as a caste, or a group that lives and exists between those who own many substances and those who own very little or nothing, the deprived. There are a few ways to consider this problem. One is pragmatic, even practical, if you will. In a democracy and a free economy, where the accumulation of personal wealth is tolerated and encouraged, the more balanced the wealth distribution, the better the chances that the haves can keep and even enjoy their material possessions. The second is more theoretical, yet not beyond the realm of possibility. In his treatise Politics, Aristotle warns that allowing the middle class to vanish or even fade leads to tyranny. To use a more current term, fascism. Or better, it leads to one of two kinds of fascism. One form is the rule of the oligarchs, or the very rich. They manipulate the system to preserve their wealth and their interest. The example of Russia post-Soviet or post-Berlin Wall Russia comes to mind. In the early 1990s, Russia experimented with democracy. The trouble was that what passed for democracy was wild capitalism. The government privatized, in a chaotic way, the means of production that it once owned and managed. There was no logic or political design behind the process. It was a Wild West, every comrade for himself approach, which ignored even the basic notion of financial recovery from the assets. Party leaders and those close to the leadership of the former state enterprises secured immense advantages. They were the extreme minority, and they managed to secure important pieces of state industry at bargain basement prices. Assets included some of the biggest mining, metal, oil, and banking companies in the world. These are the people that we call the oligarchs. Aristotle would have described them using the same term as well. The lesson that Russians learned was one that would have worked well in the Wild West as well. Capitalism displays criminal characteristics at its roots. Or what passes for capitalism develops where there are no rules. Certainly, this is not the capitalism that Adam Smith had in mind. The West is edging closer to that kind of democracy, even if through a different route. Traditional politicians have possibly forgotten what they must say to win. Or perhaps they're afraid that saying those things steps on some powerful toes, the ones of those who really have control. The end of res publica, the public affair. Private interests have gradually taken over the state in the West. Thus, the public interest, res publica, in Latin translates to public affair or commonwealth, but is better known as republic, matters little. Social discontent may not be intensifying as it was in the former Soviet Union, but it's becoming stronger. People are realizing that their expectations are too optimistic. Once, we could expect each successive generation to live better in relative terms than the one that preceded. But now the expectations of capitalism and democracy have been disappointed. This is the realm of political and economic opportunists. Public opinion is becoming, or has become, disoriented. Perhaps, therefore, many are looking for strange explanations, beyond logic, for electoral results they refuse to accept. It's not fake news that's the problem. It's a breakdown of the foundations of democracy. Opportunists like Trump in the United States and others in Europe, the elections in Germany, France, Italy, Austria, Poland, Hungary, and beyond have shown this, have noticed the crack in the system. And they're exploiting it. The meaning of Trump and other populists, the serious and old-style politicians, who still have a concept or a political philosophy, whether from the right or the left, are becoming extinct. Nobody wants to risk their careers by having models to defend. Politics, or what passes for it, has become fluid. It moves freely without pre-established goals. It is the system that promotes the Trumps of this world. Without clear rules, there is no capitalism. There is anarchy. Thus, the middle class is worth preserving, if for no other reason than to ensure that rules and boundaries exist within which capitalism can thrive. Now, political leaders who have appeal tend to come from worlds beyond politics. The process started in Europe and Italy, in fact, where all major Western political experiments began in the 1990s. It's gaining strength and Trump is the result. Still, there will be more Trumps, and not as benevolent. The anarchic democracy we are experiencing could produce violence. Look at college campuses today. Who's there to pick up the pieces? Some wealthy oligarchs of our own, the Silicon Valley types, are already in political office. The Jeff Bezos and Mark Zuckerberg types become richer every day. Yet, having achieved more wealth than anyone could dream, they will want political power. And a vacuum of the middle class will enable these desires. They will create the fascist dystopias that George Orwell warned us about in 1984. It's dangerous and only a strong middle class can avert a full system collapse. Aristotle promoted the idea that the best political community is formed by the members of the medium class. Indeed, when most citizens identify with the middle class, they produce the best political system we can imagine. It is in such a climate that peace and democracy can find stability and thrive. In a sense, it's where mediocrity prevails. But mediocrity is the very definition of middle ground. It's the Goldilocks of social constructs. In contrast, too many differences generate discord. They encourage struggles among individuals and classes. They encourage the desire to dominate, what we call tyranny. The Pew Research Center published a survey about the middle class. It showed that Americans are quickly becoming disillusioned. Many feel that the middle class is collapsing and that wages are stagnating. In 2008, around the start of the financial crisis, the percentage of Americans claiming to belong to the middle class was 53%. Now, this number has dropped to 44%. The main problem is that 2/3 of Americans believe, and few would correct them, that the gap between the rich and the poor is increasing and that the trend is irreversible. Other studies have shown that the income goalposts, what it takes to enter the middle class, have become wider. In Silicon Valley, those earning $400,000 a year claim to be middle class. The socioeconomic trends and statistics confirm many citizen sensations. The United States is losing the democratic spirit of its founding fathers. It has become an oligarchy in which the financial and technological elites are increasingly dominating. And when the rich want something, they get it. It has become increasingly so. The expectations and hopes of average Americans count ever less, and the poor are becoming poorer. The American dream has become an American nightmare. The decline of the middle class in the U.S. started before the financial crisis. It started in the early 1990s. New technologies heralded the new economy, eroding jobs and salaries of blue and white-collar workers. The 2008 financial crisis was the final blow that cut privileges for those who had survived or even thrived. The process started with job cuts and wage stagnation. And it continues as such now. Allowing this to continue will exacerbate resentment and cynicism, generating trouble for all.
Cryptocurrency News Channel. Your new future. Thank you. Follow us on YouTube.